Even before the pandemic pushed the US housing market into overdrive, the price of the average American home was on a rocket ride, climbing more than 50% between 2012 and 2019. It was the third biggest housing boom in the American history. And then came the pandemic, marked by a buying frenzy and a selling freeze, which created a supply-demand imbalance that made the prices boom even further. The real estate party is in full swing. Double-digit appreciation is the new norm these days. Sellers are filtering through multiple offers, whereas buyers are forced to pay more than the asking prices, sometimes as much as $100,000 over the asking price. The National Association of Realtors said that the prices of existing homes soared a record 17% from March 2020 to March 2021, a pace that exceeded even the appreciation seen in the last boom. Appreciation has cooled since, but only a little. Prices rose 13% from September 2020 to September 2021. The average price of American homes, in real terms, is now the highest it has ever been. The last time the US housing market looked this hot was back in 2007. If you remember, what came afterwards was the Great Recession of 2008. Home values crashed with disastrous consequences, and the global economy plunged into the deepest downturn since the Great Depression. Housing market plunged 60% and bottomed out in 2012. Now that the housing market is in full swing again, buyers and homeowners are asking a familiar question. Is the housing market so hot that it is about to crash? Housing economists agree that no painful crash looms on the horizon. The consensus is that the current housing boom will flatten in 2022 or possibly early 2023 when mortgage interest rates rise. There is, however, no bubble to burst, though prices may come down a little bit from panic buying highs. Housing economists point to 6 compelling reasons that no crash is on the horizon. First, inventories are at record lows. The US housing market is currently experiencing a severe housing shortage, the likes of which we have never seen before. The lack of inventory explains why buyers have little choice but to bid up prices, and it also indicates that supply and demand equations simply won't allow the prices to crash in the near future. Second, builders cannot build quickly enough to meet the demand. With the current demand, there is no way for home builders to buy land and win regulatory approvals quick enough to keep up. While builders are building as much as they can, a repeat of overbuilding that happened nearly 15 years ago and led to the 2008 housing crash looks unlikely. Third, mortgage rates remain near historic lows. Mortgage rates hit what was then an all-time low of 4% in 2011 and then remained in that neighborhood until the pandemic when they hit 3%. The decline in mortgage rates in 2020 dropped the monthly payment on a house by 12%, enabling people to buy houses now rather than later. Fourth, demographic trends are creating new buyers. There's a strong demand for homes on many fronts. Many Americans who already owned homes decided that during the pandemic they needed bigger places. Millennials are a huge group that are in their prime buying years, and Hispanics are a young, growing demographic keen on home ownership. Additionally, some people saw a future of remote work and wanted more space, which often means moving out of an apartment into a single-family house. Others found urban living less fun, so they headed into the suburbs where houses are more common than apartments. Number 5, lending standards remain strict. In 2007, lending standards were pretty sloppy. Lenders offered mortgages to just about anyone, regardless of credit history or down payment size. Today, on the other hand, lenders impose tough standards on borrowers. The typical credit score for mortgage borrowers in the third and fourth quarter of 2021 stood at a record high of 786, according to the Fed Reserve Bank of New York. And lastly, number 6, foreclosure activity is muted. In the years after the housing crash of 2008, millions of foreclosures flooded the housing market, depressing the prices. That's not the case anymore. Most homeowners have a comfortable equity cushion in their homes, and lenders have not been filing default notices during the pandemic, pushing foreclosures to record lows in 2020. So are we in a bubble? Bubbles are defined as when prices of assets, such as houses or stocks, depart from their fundamentals. Fundamentals are what an asset is actually worth. And all the indication points to the fact that this boom is not a bubble, because the rise in prices is easily explained by the fundamentals of cheap mortgages and supply limitations. The boom did produce some frantic buying, bids in excess of asking prices, and plenty of worry amongst would-be homeowners. But this has not been a bubble. A bubble is not simply rising prices, but demand not justified by fundamental economic factors. Here's the final word. Yes, home prices are pushing the bounds of affordability, but no, this boom should not end in a bust. Although prices are unlikely to fall nationwide, there will probably be easier buying opportunities in 2023.